There are moments in history when everything looks calm on the surface, but underneath, the currents are already shifting. 2025 is unfolding exactly like that. Markets are hitting new highs, the news is filled with reassurances, and people are starting to believe that every fear has been left behind. But then, strange signals begin to appear. Signals coming from the very people the entire financial world listens to. Warren Buffett, a man known for remaining calm in chaos, is holding an enormous pile of cash, over $300 billion. Not to show off, but to defend. And Buffett never defends for no reason. Jamie Dimon, who has steered JP Morgan for decades, has sold shares of his own company. The first time in his career. No long explanation, just a quiet action that speaks volumes. Across America, other bank executives have begun doing the same. Not on CNN. Not announced at press conferences. They simply sell, close their briefcases, and leave their offices as if they know something the rest of us don't. And this is where things get frightening. Because in finance, people can say anything. But money does not lie. When the most powerful players quietly change their positions, it is never a coincidence. If you watch until the end of this video, you'll understand why they're acting this way. You'll see the data they see every day, and you'll understand what they're trying to hide from the public. Because what's coming is not a cold breeze. It's a storm moving in silence, and the time to prepare is slipping away faster than anyone wants to admit. American financial history always leaves clues. They're never obvious, but they're always there, quiet and unsettling. Only when we look back do we realize the storm started long before it arrived. A picture-perfect autumn. Wall Street, bathed in sunshine. The press celebrating, investors believing the nation was entering an era of endless prosperity. No one knew that just weeks later, Black Thursday would rip that dream apart. When confidence peaks, that's when things are most fragile. Nearly 80 years later, in 2007, American families were buying homes more than ever. Banks reported record profits. CEOs claimed the risk of recession was nearly zero. But beneath that confidence, subprime mortgages were quietly piling up. A fire was burning behind the glass walls of the financial towers. And then, 2025. Once again, we see the familiar calm before the storm. Markets rising. Leaders saying everything is under control. Media calling it a new cycle. But if you pay attention, you can sense that strange energy. The feeling only those who live through crises truly understand. A stillness that is not peace, but anticipation. The moment before a storm is always when the sky looks most beautiful, and also when it's most dangerous. 2025 is making the sky look beautiful in an unnatural way. When you look at America today, you'll see two different stories happening at the same time. One told on television every night, and another written in numbers most people never see. On the news, the tone is calm. They say the economy is having a soft landing. They say businesses are stable. They say consumer confidence has returned. Words that sound familiar, like a song played too many times. But if you step back and truly look at the data, you'll see cracks spreading. GDP growth has slowed to just 1.5%, much lower than the year before. Manufacturing and services are weakening. Consumers are borrowing less and spending more cautiously. These are not signs of a healthy economy. They are signs of a society beginning to worry. Lower interest rates might sound like good news, but in banking, they're a warning signal. Bank margins have fallen to their lowest level since the financial crisis. That usually happens when banks struggle to profit from loans and when businesses stop expanding because they sense something is wrong. Meanwhile, independent economists are making predictions that should make anyone pause. The man who forecast the 2008 crisis says the probability of recession this year is 80%. Others give even higher numbers. These aren't pessimists. These are people who were right when the entire world was wrong. The alarming part is the growing gap between the two stories. One side says everything is fine. The other says danger is approaching. Whenever history shows this kind of contradiction, it's never about disagreeing over data. It's a sign that the truth is being blurred. And in American finance, a blurred truth has never led to anything good. Every financial system has a place where the light doesn't reach, a place where transactions occur without ever appearing on the evening news, a place where massive loans can reshape markets but never show up on public balance sheets. This place is called the shadow banking system. And if you think it's just a tiny corner of the economy, consider this: $68 trillion in assets are operating behind that curtain, more than the size of the entire U.S. economy. But the frightening part isn't the amount of money. It's that no one truly knows how it's being used. After the 2008 crisis, America tightened bank regulations. But when the front door was locked, the risk didn't disappear. It slipped out the back. Complex loans, vague credit contracts, and unregulated transactions moved into the shadow banking world. No oversight, no accountability, and no rescue plan if things collapse. What makes this even more fragile is how traditional banks joined the game. They didn't stand aside. They provided funding to private credit funds and non-bank lenders, giving money to entities they would never directly lend to. They were lending to the lenders, avoiding the need to record the real risk on their balance sheets. When markets are calm, the system works like a smooth machine. But when stress hits, the network turns into a maze. One broken link shakes the entire chain. Small losses turn into huge losses. Small risks become catastrophes. The uncertainty is the most dangerous part, because in finance, you can only fight what you can see. But here, an entire system is operating in the dark. Even senior regulators admit they cannot map out all the connections. We don't see the flames, but that doesn't mean nothing is burning. And when darkness hides a sum of money big enough to shape the fate of the economy, every moment of silence becomes dangerous. The danger in America's economy today isn't found in isolated risks. It lies in how those risks are connected quietly, tightly, like electrical wires hidden inside an old building. When things are fine, everything works smoothly, but one spark can burn the entire structure down. In 2008, the crisis began with a single financial product: subprime mortgages. One spark, one origin. But in 2025, the picture is far more complex. Risk isn't trapped in one box. It's woven through relationships between traditional banks, shadow banks, private credit funds, insurance companies, pension funds, and commercial real estate. When one part of the system fails, it doesn't stay still. It spreads. Like a wave hitting the shore, pushing into other waves, creating a chain reaction that cannot be stopped. One institution loses liquidity, another gets hit. One fund struggles, the bank behind it absorbs the loss. One commercial real estate loan defaults, and pension funds and insurers feel the shock. Regulators admit they cannot fully map these hidden connections. No one has a blueprint of the system. No one knows where every wire leads. And that ignorance is the greatest vulnerability. If you don't know what's connected to what, you can't know how fast the shock will spread. A small bank failure could ripple into a large one. A struggling credit fund could shake the bond market. One bad loan could trigger widespread fear. Connections make the system strong, but those same connections, under pressure, make it more fragile than ever. A tiny slip can become a landslide, and no one knows which stone will fall first. If there is one ticking time bomb in the entire financial system, it isn't in shadow banking or consumer debt. It is right in plain sight. Commercial real estate, where thousands of office buildings, shopping centers, and financial towers are quietly carrying a burden almost no one is talking about. In 2025, $957 billion in commercial real estate loans will come due. Not only is this massive, it's 3 times the average of the past 20 years. Even worse, this wave of maturities is hitting at the exact moment the commercial real estate market is weakening faster than at any time since the Great Depression. Office values have dropped more than 20%. Buildings in cities like New York, San Francisco, and Chicago can't keep tenants. Remote work has emptied entire floors. Revenues are down. Maintenance costs are up. And most importantly, the ability to repay debt is collapsing. Imagine owning a building once worth $100 million. But after rates rise and the market drops, it's worth only $72 million. To refinance, the bank demands you put in $18 million in cash. Most owners simply cannot, so they walk away, surrendering buildings they spent their lives building. This isn't just happening to major corporations. It's happening to mid-sized and small owners, people who spent decades building wealth for their families. They believed real estate was the safest place to store stability. Now that belief is betraying them. And who holds most of these loans? Not the Wall Street giants. Regional banks, the same community lenders people rely on for small business loans, home mortgages, and savings accounts. When a building defaults, the owner isn't the only one hit. The bank behind it absorbs the loss. $957 billion is not just a number. It's a chain reaction waiting to spread across America, from quiet neighborhoods to bustling financial districts, from small businesses to regional banks, from a single city to the nation itself. This isn't just a financial bomb. It's a deeply human story about dreams threatened, families facing loss, and a system no longer strong enough to absorb another blow. In the spring of 2023, America witnessed something many believed impossible. A seemingly solid bank, Silicon Valley Bank, collapsed in just 48 hours. Not because it went bankrupt, but because something far more dangerous happened. Its assets fell in value too quickly as interest rates surged, and when depositors panicked and withdrew their money, the bank had to sell everything at enormous losses. A death spiral began, and SVB never had a chance to recover. Now imagine that scenario, not with one bank, but with dozens, even hundreds of regional banks across America. Banks where everyday people deposit their savings. Banks that fund small businesses, family stores, farms, and homes. Banks that cannot reorganize billions in assets like the Wall Street giants can. And tragically, these are the same banks holding most of the underwater commercial real estate loans. If only a few property owners defaulted, the system could endure. But when hundreds of loans fail to refinance at the same time, regional banks face a situation they have no tools to survive. Assets lose value. Loss reserves spike. Depositors grow anxious. And long lines could form outside bank doors just like 2008, but wider, faster, and harder to control. The saddest part is that these community banks did nothing wrong. They serve their towns with sincerity. They help families buy their first homes. They support small businesses through hard times. But now they are victims of forces far beyond their control. When a regional bank collapses, it isn't just financial news. It's a blow to an entire community. A store closes, a factory loses working capital, a family loses a lifetime of savings, a small town loses its financial heartbeat. The SVB collapse showed how fast panic can spread. What's more frightening is that the conditions that destroyed SVB are reappearing this time on a much larger scale. And when regional banks tremble, the entire nation feels the aftershocks. In finance, no risk exists alone. They're like tightly stretched strings overlapping in a silent room. When one snaps, all the others vibrate. And today, every string from commercial real estate, to private credit, to insurance, to pension funds, is being pulled to its limit. We already discussed the $957 billion commercial real estate bomb. But look wider. Who has been funding these loans for the past decade? Not just banks. Private credit funds, entities operating in the shadows. They lent aggressively when banks faced stricter regulations. And now, with property values plunging, they are the ones suffering the heaviest losses. But it doesn't end there. Many private credit funds borrowed money from banks to lend into real estate. When real estate borrowers cannot pay, the funds cannot repay the banks. And when the funds default, the banks take the hit. A closed loop. Risk never disappears. It simply returns to where it started. Then there are insurance companies and pension funds, the institutions Americans trust with their futures. For years, they invested heavily in commercial real estate, believing it was safe and stable. But now, those once calm investments are becoming burdens. A building losing value isn't just an owner's problem. It affects millions of retirees who rely on pension returns. Teachers, factory workers, citizens who spent their lives saving for a peaceful retirement. When all four pillars, commercial real estate, shadow credit, insurance, and pension, struggle at the same time, the financial system doesn't just wobble. It begins forming feedback loops, amplifying every shock, making it larger, louder, and harder to control. What makes this story even deeper is that it's no longer about corporations. It's about ordinary people, depositors, retirees, small business owners fighting to stay afloat. When risks intertwine, no one is truly on the sidelines. And when one part of the system falls, every other part feels the weight. From the outside, the financial system may look stable. No panic, no long lines at banks, no cascading failures like 2008. But the calm doesn't exist because the problems are solved. It exists because the system is trying to keep the surface as flat as possible. In banking, this strategy is called extend and pretend. When a loan is about to become delinquent, instead of recognizing the loss, the bank extends the deadline, hoping the market improves and that the financial statements won't show anything alarming. For property owners, it's a temporary sigh of relief. They know their building has lost value. They know the cash flow isn't enough. But when the bank gives them more time, they cling to that hope, partly because they need it, and partly because they have no alternative. But time only delays the feeling of danger. It doesn't change the underlying reality. When the day comes to refinance, the numbers are still the same. Property value is too low, rates are too high, equity is gone, and walking away becomes the only option. The danger of extend and pretend is that it creates an illusion of stability. Government agencies think everything is under control. Consumers continue spending as usual. Markets operate on routine. But behind that painted surface, the real numbers are rotting. That is why the crisis hasn't erupted. Not because risk is shrinking, but because the system is delaying the moment it must face it. Each extension tightens the tension a little more, like stretching a guitar string to its breaking point. Eventually, the string will snap, without warning, without time to prepare. The crisis hasn't disappeared. It's simply waiting for the moment when pretending is no longer possible. When the financial world grows noisy with reassurances, there is a group of people who choose silence instead. They don't need to say much. Because in investing, actions always speak louder than words. And if you look closely, you'll see those actions telling a completely different story. Warren Buffett, often called the Oracle of Omaha, is famous for his calm demeanor and his ability to see through short-term volatility. But right now, he is holding the largest cash reserve of his entire career. Over $300 billion not being invested, not being thrown into the stock market like in the boom years. It just sits there, waiting. And Buffett only waits when he believes something bigger is approaching. He's not the only one. Jamie Dimon, who leads J.P. Morgan, one of the strongest banks in America, has sold shares of his own company. The first time in his career. He didn't give a long speech. No drawn-out explanation. He simply sold. And in the financial world, moves like that always have a reason. A wave of other bank executives is doing the same. They're trimming positions, reducing their ownership, shifting assets into more defensive forms. These decisions don't appear on newspaper headlines, but they're recorded in internal transaction filings. These people may smile on television, may say that everything is fine, but their actions show they don't believe that. Major investment funds organizations managing trillions of dollars are also shifting. They're cutting risk in sensitive sectors. They're building cash and short-term bonds. They're staying away from areas once considered safe. In a market flooded with optimism, their extreme caution is a warning far stronger than any financial news report. The most notable thing here is that powerful people don't wait until a crisis hits to act. They prepare months, sometimes years, in advance. They are the first to see the dark clouds forming on the horizon, even when the sky right overhead still looks clear. And if they're building walls, pulling back, and stockpiling cash, then perhaps the question each of us needs to ask isn't what will happen, but when we'll finally start preparing. To many people, what's happening may sound like a pessimistic story, a series of warnings, a dark picture that feels exhausting. It's easy to believe everything will pass, just like previous crises. It's easy to trust that the U.S. financial system is too strong to break. But sometimes, the truth isn't found in optimism. It's found in math and history. Because at this point, the question is no longer whether a crisis will happen. The real question is when it will happen and how long the system can hold before it fractures. Look at the full picture. Massive commercial real estate loans coming due. Thinly capitalized regional banks absorbing hidden losses. Shadow banking and private credit operating with high leverage and almost no oversight. Households tightening spending as incomes fall behind rising prices. And most importantly, a financial system so interconnected that a single break can shake the entire chain. These signs are not scattered. They are aligned, like puzzle pieces forming a clear image, and that image tells us time is running out faster than most people think. The most painful truth is that the first to suffer won't be hedge funds or giant corporations. It will be ordinary people. Families trying to keep their homes, retirees relying on pensions, small businesses fighting to pay their workers. They will feel the shift before they even understand what's happening. When you look at the entire landscape, you see a system not weak in one place, but weak in many places at once. And the danger isn't the size of each individual risk. It's that all of them are happening at the same time, woven together. Creating pressure, even the strongest financial structures cannot withstand forever. The crisis is not a ghost from the distant future. It is a reality moving closer, day by day, week by week, loan by loan. And the cold truth is that the only thing we don't know is the exact moment the system stops holding. When you step back and look at everything happening from commercial real estate to regional banks, from shadow credit to the quiet movements of financial elites, you realize we are standing at a pivotal moment, not a moment for fear, but for clarity. Because history always rewards those willing to open their eyes. A crisis is not the end. It is a test of preparation. And the most important factor right now isn't power or wealth. It's readiness. Whether you act before the door closes, review your finances, cut unnecessary risks, strengthen your family's safety cushion, learn where your trust and assets are placed, and most importantly, don't wait for panic around you to start protecting yourself. Those who prepare early are always the ones still standing at the end. And when the storm hits, the difference between chaos and calm is whether you were ready. This is not a prophecy. It is a reminder. There is still time, but not much.